Hi, Steve Van Metre here, and welcome to your Monday night premiere. We take about 15 minutes every Monday and Wednesday night to try to make sense of markets that don't make much sense. As you know, I probably don't want to talk about the trade war, but it is front and center once again. We did hear from the China state media, which, if you don't realize this, China uses its media to communicate. And unlike our media, which has freedom of press, China's media really doesn't. So when you hear something that is printed in their newspaper, you can almost bet everything you have that report was vetted prior to it being published by people high up in the political administration. And what we learned is that China said that if there's not a rollback in the tariffs, there won't be a phase one trade deal. This is not new news but we've kept hearing from the Trump administration that we're very, very, very close. And then China's follow-up in that article was a suspension or a cancellation of the December 15 tariffs wasn't good enough. And now we're starting to hear the truth. Is the Trump administration was offering to cancel the upcoming December 15 tariffs for a phase one trade deal, and China is essentially saying no. Then today we heard from Ross, I forget what his title is in the Trump administration, and he said that President Trump is prepared to go forth with the December 15 tariffs. And here again, not to be political, because I don't want to take a side on this one way or the other. It does seem like President Trump has no choice at this point. He has punted the ball several times and either delayed or canceled tariffs. But the reality is, if he's not going to get what he wants, if he keeps punting, it probably isn't going to look that good. So at the moment, we have to believe that the December 15 tariffs are on. And from an investment standpoint, the reason the market's skittish about this is because corporations have been absorbing the tariffs for the most part right now. But this next round, they won't be able to. They are going to be on consumer goods. So that is a negative, and why the market didn't like that. Of course, a short while later, another Trump administration official said that they thought we would have a deal done by the end of the year. The reality is, if the December 15 tariffs hit, it's probably not going to happen. Nevertheless, we did get a bunch of deflationary news, but what was really weird last night is after the Chinese factory data, which should never be taken as the truth, because again, the Chinese government is well known for adjusting their data. Now, I'm not saying that we don't have our own versions of manipulation, but ours have rules and theirs don't. And so they showed that their manufacturing sector resumed an expansion, not a great one, but a small expansion. And literally out of nowhere, Treasury yields got hammered straight up. Now, this is interesting, not because it's correct move, is because the market then thought, with the U.S. releasing their factory data today, that it is going to be super amazingly bullish and inflationary. And it wasn't. So with that, we will move right on to the content of this video. Provides educational information only and is not intended to provide investment or other advice. It is not to be construed as a recognition or solicitation by selling a security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Business expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. And that is what happens when you are not prepared to click your screen. All right, so I want to show you the factory data. It could not be more deflationary or disinflationary. It was not good. Now, the JP Morgan did come out with a report to say that the global manufacturing sector slightly entered an expansion. Now, I didn't look through all the details of their report, but from the major factory surveys that I saw, it seems like the manufacturing sector around the world is still in a contraction. So I don't know, how they weighted or exactly what they did. But let's go look at the ISM Purchasing Managers Index. As you know, this is recorded live. It is published later. So the index was expected to rise. Now, we don't see the expectations here, but it fell to 48. Now, just so you know, if you've never seen one of these before, let's see if we can zoom that in a little bit. Anything under 50 denotes a contraction. Over 50 is a expansion. And of course, the farther below 50, the bigger the contraction. The farther above 50, the bigger the expansion. Let's look at new orders. These fell from 49 to 47. Production is increased. So what we're seeing is new orders are coming in. There are not as many are coming in as the way you read this. Now, when we go and look at backlog of orders, this is you coming into work and you go, oh, I've got 3-6 months worth of orders to produce because I've got a backlog. Well, we can see the backlog of orders went from 44 to 43. So what this means is there were fewer new orders and the backlog is falling because production is running pretty well. And all that means is the factory sector is indeed contracting. And when you have less or fewer back orders and fewer new orders, what are you going to not need as many of? Well, that's the employment sector. And so you can see it went from 47, which was in contraction, down to 46, further contraction. Supplier delivery is not really an issue, so obviously there's no problem getting stuff out of the factory. Inventories are contracting. I think inventory, you say, well, that could be bullish. It could be, but it doesn't tell you how big the inventories are. And I believe the inventories, because a lot of companies and manufacturers front ran the tariffs, I think inventory is a lot bigger than most people realize. So a contraction here, long-term is a good thing. Short-term perhaps might not even be enough to matter. Customers' inventories are also reducing, but here's something disinflationary prices. Prices are still contracting. They went from 45 to 46. They're just decreasing at a slower rate. So when you think about rising interest rates and you start to look at this report, when you have contracting new orders, slowing production, contracting employment, contracting the inventories isn't really a problem here, but looking at prices, contracting backlog of orders, how does that lead to higher interest rates? It doesn't. Newer export orders is also contracting, and imports are also contracting at a slower rate. So this wasn't a very good report, but yet the market liked it because it wasn't as, well, it could have been worse, apparently. And so that takes you into this chart here from Bloomberg and Morgan Stanley Research that shows the year-over-year rate of change of the S&P 500 in blue and the year-over-year economy-weighted composite PMI, which, and we've talked about this before, that stocks are pricing in a massive reflation in the economy. They're completely running against the economic data, and we continue to see a decline in the global PMIs, which suggests that either the stock market happens to know something that the factories don't, or the factories know something the stock market is not ready to come to terms with. So looking at some of the other data from today, total construction spending was revised lower in October and came in at minus 0.8% in November. So October went from plus 0.05 to minus 0.03. Now, interesting enough, the year-over-year rate of change did increase. So you look at this, you go, there's reflation here. I don't think so. One way to kind of tell, there's one real key. If you can always look at the direction of Treasury yields to what's going on here with, whoops, is that the right one I wanted? Let's see, 3-month Treasury bills daily. There we go. And we can add on this, which is 3 months Treasury bills. And we got to clean this up a little bit so you can see it correctly. And so we'll let it do that, close that, and we'll move this over. Oops. And so what Treasury yields are saying, the 3-month Treasury yields you can see in red, are suggesting when you get in the late stages of an expansion and yields start to fall, it means financial conditions are tightening, and that means construction spending should fall. Now, mind you, construction spending was only up 1% over last year, so it's not a whole lot. We would really want to see a big move higher like we did. Let me clear that off so we can all see it, or at least I can see it. Maybe it'd be easier for you, where we see like a big jump, 5%, 7, 9, something to say that we're really coming out of the bottom. And usually you get big moves. A small move like this isn't that big of a deal. But for Friday, which is the non-farm payroll report, And we've looked at this before, the total construction spending. Of course, treasury yields also play a role in this, that it tells us that non-farm payrolls, this is showing on a year-over-year basis, should decline. And we can go here and put, let's see, change from a year ago. Will that do what we want? Or, oops, not, oh, whoops, that's the wrong one. I meant to change. Total employees non-farm. Here's the headline number that you see, the thousands of persons seasonally adjusted, and we should expect to see this come down. Now, on Friday, the GM employees from the strike are going to come back on the payrolls, but this thing should be heading lower, a lot lower. And based on its relationship with construction spending, you can see that. So not overly bullish in the data today at all, and yet the market sold off treasury yields. It doesn't make much sense to me. And it will be reversed. I'll show you why. And so we had a big move down, the S&P 500, same with the NASDAQ, some late buying. The Dow obviously didn't get any of that, and even small caps went down. But let's take a look at 30-year treasury yields. You can see they just got slammed higher, and there's a gap here. Now, there's some gaps up here that will need to be someday filled. One of the problems is the data does not suggest at all that there's any reflation. I mean, you can't look at that factory data and say, man, I see a lot of good things that are going to cause interest rates to go up because there's a bunch of demand coming into the factory sector. If you look at that and you see contraction, yes, the contractions are slowing, but that doesn't mean they've stopped. So we saw yields get slammed higher, created a gap. This gap will need to be filled. It, by virtue of it gapping higher, it filled a very tiny gap here. Now there is a gap way up here and here. All gaps eventually are filled, but the data is very, very bearish for treasury yields. There's really nothing in the data today that would give us any indication otherwise. So if we look at the long bond TLT, it got hammered down to support here. Now from a charting pattern, we looked at this we've looked at this last couple of weeks, what's called a flag pattern. And so you see kind of a flagpole here, and then if you kind of envision two lines here, it looks like a flag. And when you break out of a flag pattern, at some point you get above kind of a line up here, and then boom, it's off to the races. Well, look, it's getting pretty close to breaking out of this. So sellers had to come in and overnight trading and just slam this thing lower. Now, from a trading volume standpoint, there's a huge amount of volume, which is excellent. Anytime you get a move down and you got a lot of volume coming in, it tells you not only there are a lot of people wanting to jump ship, but it tells you there's a lot of people that are wanting to buy here. And so you tend to get what is referred to as stopping volume, where it stops and moves lower. My expectation based on the data is yields should continue to fall and bond prices should continue to rise. But this was what I would say more of a tactical move last night, was just to get sellers to sell. And it worked, but they really didn't come in and sell, obviously, until the final trade. There was some selling going in here, but you can see this is the resistance or support line, and every time it came through, buyers, came down buyers. So it held support really well, and nothing in the data indicates otherwise. Now tomorrow we'll get I believe we get the red box retail sales from the week before, and we get some other the services sector on Wednesday, along with crude oil. Now I know normally we have the data on hedge fund managers, but I did not realize, due to the market closing early on Friday, that data was pushed out to today. So it was not released until 1:30. And Hedgeopia, who, as you probably know, we used because he aggregates it into nice charts for us, but he also does a write-up. And so because he hasn't done his write-up, because he's probably putting together the charts this afternoon, he already posted one on Twitter, so we know he's working on it, means we will probably have to wait until Wednesday to see how a hedge fund manager is positioned. But based on the big short move today, it tells us that speculators are trying to drive yields higher because they know the data is moving against them, and they need to get people to short the bond market to buy stocks. And once they're exhausted of their selling, then you should see bond prices head into their next into a bull market by breaking to the upside of that flag pattern. So we'll get back together on Wednesday and see what the data brings us. Until then, I'm Steve Van Metre. Thanks for watching. Bye now.